Hello, Vetted VA community. My name is Hammer, and today is December 20th, 2023, and I'm coming at you with your mortgage market update. It's the weekly call that we do every Wednesday at around this time. In fact, let me take that off. I don't need that today. So anyway, I am here today to talk to you about what's going on in the mortgage market, what's going on with rates and pricing, where rates are headed as we go into 2024. And I usually have my slides all up and ready, but today I'm going to skip the slides. We're just going to give you some quick background on where things are at. And then I'm going to show you some fancy screens. And I want to show you why, to educate you on where things are going. And again, because all of us, it's like throwing darts at a dartboard right now. We come and we give you these forecasts, but I want to show you what's controlling where rates are coming from so that you can have an opinion on where rates are going to go. So anyway, thank you for joining me. Quick recap on where things are at. Mortgage rates have been very much the same for the last couple of weeks now. Last week, we had a Fed meeting, and we saw a very big improvement after that Fed meeting. So that was, in my opinion, what I called a Hail Mary. Last week, if you watched the recap of that show, I talked about the fact that we had labor reports that showed the labor market still very strong. Now, the Fed has a mandate. Their job is to maximize employment and what they call price stability. Generally, they want to keep inflation at about 2%. That's what they call price stability. So the Fed, they have this role that they have a couple of tools that they can manipulate, and that they're trying to keep unemployment. They want to maximize the employment out there, keep unemployment low, and they want to do price stability, which is to get inflation to about 2%. And they do want inflation. Inflation is actually part of a healthy economy. So the labor data that we got at the beginning of December showed the labor market was about where it was expected, and it was pretty strong. And because of that, we were looking at, what about the inflation, right? Is inflation coming in better than expected? And the reason that we wanted to see how the labor market did and the inflation did is that if the labor market starts to soften, if the economy starts to weaken, if inflation continues to get better, well, the Fed will start to cut their Fed fund rate. And their Fed fund rate, they don't set mortgage rates. The Fed does not set the mortgage rates, but their Fed fund rate circulates basically through the economy and adjusts all the other rates. And again, it's an oversimplification, but it's how things work. So we got the inflation data last week, and it wasn't overly impressive. It came in right about as expected. It shows that inflation is still declining, but not tremendously. So last week when I did the show, I didn't expect that we were going to see too much of a move after the Fed meeting, because I had said we had a whiff on the labor data, we had a whiff on the inflation data, and that would most likely equal a whiff on the Fed meeting. We knew the Fed wasn't going to raise interest rates. Markets were betting on that, right? After seeing rates rise from March of 2022, we've seen rates rise over the last 18 months. We knew that this would be the third meeting where they did not raise rates, but we didn't think that they would message that things were going to improve that much. However, what happened last week is, let me show you one of those fancy charts that I promised you. So last week, we got what we call the dot plot. Now, the dot plot is where each of the 19 different Fed members anonymously vote, and they cast their vote on where they think that rates will be, the Fed fund rate in particular, at the end of each of the year. So at 2023, they said that the Fed funds rate would be at 5.25. That's what all of these are. And it was unanimous, right? And this was the majority. Light blue is where the median, right? So everybody said, we're going to end this year at 5.25. Well, that was pretty easy, because at the last meeting, they didn't raise interest rates. So therefore, we're going to end the year at 5.25. But for 2024, there were some members that thought that rates would have to stay that high. And there were some that thought that rates would have to cut really low. But the general majority was somewhere in the middle, right around 4.75, which would be, 4.5, which would be 3 rate cuts right now, because we're at 5.25. So the Fed basically came out and said the current expectation is that we're going to see 3 rate cuts in 2024. Now, again, when the Fed cuts interest rates, it doesn't mean that they cut rates and mortgage rates instantly go down. They're not cutting mortgage rates. However, As they cut that Fed funds rate, it's going to affect all the rates for the economy, consumer rates, credit card rates, car loans, all the different rates that are out there, including mortgage rates. Now, the good thing is, though, mortgage rates actually react early to all this news. And the reason they do so is because of all the fancy charts and the candlesticks and the things that I like to show you guys sometimes and that you'll see here. So we're looking right now at one of these fancy charts and graphs. Now, right here, this big move, this was Wednesday, December 13th. We had this very large green candlestick. And what we're looking for in this particular chart, when we see green candlesticks, each one of these lines is called a candlestick because it looks kind of like a candlestick. You have a fat body. You usually will have some kind of a wick is the top. And if it has a tail, that's at the bottom. And the way that these candlesticks work is that whatever the body is, that's where we started and ended on that day. So on this day, we started low and we went up and improved. That's why it's green. On this day, and let me get that box out of the way. On this day here, we started higher and ended the day lower, so it's red, and red is bad, right? So red means mortgage rates get a little bit worse. Green means mortgage rates get a little bit better. And this happens every single day. And what we're tracking, these are called mortgage-backed securities or universal mortgage-backed securities. These are the bonds that are used to replenish money into the housing market so that there's always money for you to borrow. There's always money for a lender to lend. What happens is that when the lender closes your mortgage, it's going to be pooled together. Now, I've got some poker chips here in my hand, right? So your mortgage is here, and then a bunch of other mortgages are going to get stacked together like this, and they get pooled together into a pool, and then this gets sold as a bond. So I may put these mortgages together, and this bond has a return on investment, and according to what we're looking at here, of 5.5%, which means that you could buy $100 worth of this bond, and it's going to give you a return on investment of 5.5%. Now, there's some risk to this bond, though, because what happens if people pay their mortgage off early or foreclose? Well, that's going to lower that yield. It's going to lower that because you're not going to get paid on those anymore. So that's kind of how the bond market works. And based on that risk, you see what the pricing goes for. So right now, we're paying what's called a premium. If I want to make 5.5% interest, I'm paying $100.33 to get a $100 bond. If I want something that pays me even more interest, I'm going to pay more. I'm going to pay a higher premium because I'm getting a higher rate of return. So if I want 6% rate of return, I'm going to pay $101.47 for that $100 bond. Well, what about ones that are maybe, a little bit less? You'll actually have ones that are in a premium where they're paying a discount. So if I'm taking lower interest rates, I may actually only pay $99 or $98 for that $100 bond. So as these bond values go up and down and the premium changes, that's how your mortgage rates change. Now, what we're seeing right now, and the reason you're seeing interest rates stay very much in the realm of where they are, is that these bonds have settled down after improving quite a bit since October. Now, you'll remember we got our worst rates of the year in October. We saw, VA rates that were in the sevens, high sevens. We saw conventional conforming rates that were in the eights. And since then, as you can tell the trend of these each individual lines, they're moving higher, they're improving. And that's why you've seen mortgage rates fall. So right now you're looking at mortgage rates. Generally, you can see VA rates that are in the sixes, maybe even in the high fives in some scenarios. But generally, you're going to find them in the sixes. You're going to see conventional conforming rates that are in the high sixes. HA rates are generally in the low sixes, maybe even in the high fives in some scenarios. And again, you want to shop around and make sure that you're getting your unique situation based on credit score and all the different variables that go into this. But if you're getting a rate quote right now in the low sixes for a VA mortgage, it's probably a good quote. Again, you should shop around, but you can at least know that you're in that right ballpark. You're not being taken advantage of. If you got a rate quote that was in the sevens, you might want to find out why. So as we look at these charts, well, basically what we're waiting to happen is we're waiting for the expectation of the Fed to maybe cut rates more than what they forecast. So the different Fed members have forecast 3 rate cuts, but markets, they trade on what we call Fed futures. And what this gives us is some insight into what is expected to happen. So right now, the January 31st Fed meeting, markets currently expect that we will see the Fed maintain rates at 5.25. That's where they're currently at. And markets believe there's about a 90% probability they'll stay that way as we head into the end of January at the first meeting of the new year. However, by March, markets are now expecting, see how we're at 5%, only about a 20% expectation that we'll actually still be at 5.25. So markets believe that there is just about an 80% expectation that we'll see at least one rate cut by the Fed by that time in March. And with markets expecting this to happen, that's why we're seeing mortgage rates improve now. And the reason I'm bringing this up for y'all is, again, just to show you what you would be looking at in order to see which direction rates are going to go. Because what happens is as mortgage rates improve, you might say, well, now I want to hold out and see if they improve more. Well, what we're looking at is over the near term, in the next few weeks, it's unlikely that we see mortgage rates improve too much more than where they're at today, unless markets believe that the Fed has to take action sooner and cut that Fed funds rate sooner. So if we look at Fed futures, we watch what's happening here, that'll tell us when that starts to happen, if it starts to happen. What would cause this? January labor market data that we get at the beginning of January on January 5th. The CPI inflation report that we're going to get on January 11th. Those are events that we'll be watching to see how mortgage rates go heading into the year. But as we go into 2024, markets believe that the Fed is going to be at 3.75. That means that they would expect to see 6 rate cuts out of 1, 2, 3, 4, 5, 6, 7, 8 meetings. 6 out of 8 meetings. I don't necessarily know that that's going to happen. If markets become a little less excited about the idea and maybe think it's not going to happen, we're going to see mortgage rates that might just creep up a little bit from here. So keep that in mind. If you have an opportunity to lock in your interest rate, talk to your mortgage professional about it. Find out if that's the right move for you. Again, only you can make that decision, whether you are risk tolerant and you want to take the risk that things may improve and you're willing to risk that they could get worse in order to get that improvement, or if you're risk averse and you're like, you know what, I'd rather sleep well at night with these interest rates being where they've gotten. And then when things get better, we can always talk about refinancing. Remember, there is an awesome program with VA mortgages called the EARL. It is the interest rate reduction refinance loan. And you have the opportunity to refinance at a much easier process than a regular conventional loan. There are some requirements. You must make 6 monthly payments before you can refinance. You have to wait 210 days. You have to save more than 5%. You have to recover your closing costs in 36 months. But again, that's something that an individual mortgage professional could help you with. So anyway, as we go into 2024, the bottom line here is the expectation is that rates are going to improve. I wouldn't expect to see any huge improvements anytime soon. I wouldn't be looking to think that rates are going to drop all the way down into the 4s, but over time, we're likely to see them move up and down a little bit. But over time, we could see that we end 2024 with better mortgage rates than we enter the year with. However, we are at least ending 2023 off of the highest rates that we saw back in October. We've seen a significant improvement. Rates have improved at, generally anywhere from a point to a point and a half. And it's quite a bit of improvement, which is nice. It is a great time. Now, remember something. As rates go down, homes are going to get harder and harder to get because we've got a few different things happening. As those interest rates come down, more people come off the sidelines, more buyers are eligible, more people qualify, which means there's a higher demand for the homes that are currently out there. And rates are not down enough yet where we see more inventory. In other words, people that got interest rates, and there's millions and millions and millions of them, people that got interest rates that are at 3.5%, they're not yet ready to give up those mortgages and move or buy another house when rates are at 6, maybe 5, maybe 4, but not 6. So we're not seeing a lot of extra inventory come into the market yet, which means you have more demand, less supply, means it's harder to get your house. So don't be afraid to act now while rates are where they're at. As rates improve, if you find a home, you get a home, you win your home, you can always refinance later. right? So keep that in mind. But anyway, y'all, that's it for me today. I hope that helps you out. I hope that gives you some guidance on which direction rates are going. Remember, if you do have any questions, please feel free to post them here. We'll be glad to answer them for you. Remember, you can go ahead and join us next week. It'll be a quiet week, but I am working, so I will be here, and I will see you next week. And I hope you have a fantastic holiday. Take care, everybody, and bye-bye.